Welcome everyone to our Association of Former Students at Texas A&M Homebuyer Workshop. My name is Jason Maida. Great to be with everyone this evening. Thanks so much for taking time out of your busy schedules. I know we're wrapping up the week here and really appreciate you guys spending some time with us. I know we're all in different time zones today or this evening, depending on where you're at. But we're obviously broadcasting this through the Central Time Zone. Really excited to be able to present this content to you. This is also our first class for 2026. So really excited. We have a really large group that's going to participate in tonight's class. In case you've heard about some of our classes in the past, these are very interactive sessions that we do. And obviously it's around home buying and really just providing you some tools and resources to help you on the journey towards home ownership. So as we go through our class tonight, we really encourage you to ask us questions. You can use either the chat feature within Zoom, you can use Q&A. I'll have both of those windows up. My colleague Ken, who's in the background there, will also be answering some questions for you. We really want to provide you a lot of just rich content that you can use as you decide on, when the timing is right, or do I, if at all, want to pursue homeownership as a financial goal for myself. And we've had the pleasure of being in partnership with the former students of A&M, and really excited to bring this at a whole new year to the local community of just to understand more about home buying. We've got a chance to help some of your fellow alum across the country purchase their first home, whether that's using assistance programs or some of the other resources that we have. So really excited about what we've been able to do in the community so far, and really just have some big things ahead in 2026 to better support the former students of Texas A&M. Well, my name is Jason Maida, so I'm going to be your presenter this evening. I work for an organization called APM. We're a nationwide lender. We do have presence in Texas, but we're a nationwide organization. So whether you're buying in Texas or Colorado, Florida, or California, anywhere in between, we can help you in your financial goals of home ownership. Our relationships with our clients start in a workshop setting like this. We have just a very kind of just easy way of just understanding more about home ownership, making a very interactive session for you that you can learn a little bit about what the process, what some of the tools look like, and the resources for you around home ownership. We're really passionate about serving our community and homebuyer education. We feel like if you can be really an informed consumer, then you're just going to be equipped with all the knowledge you need to make a really great informed financial decision. Now, tonight's talking points look like this. We're going to talk a little bit about the housing market, what's happening with interest rates, and kind of a little bit of the back and forth that we're doing right now with interest rates. We'll spend some time looking at budgeting for home ownership. I have a really, I think, a pretty cool calculator that you'll be able to look at. It's a rent versus buying calculator just to measure that rental situation you have today versus what home ownership could be. We'll talk a little bit about credit. I want to give you kind of a couple tips just to think about around credit so we can kind of maximize credit score. We'll talk about loan programs tonight, savings for home ownership. We'll dive into a few first-time homebuyer programs that are, we have some Texas-based programs, but we do also have some nationwide first-time buyer programs. And, it'd be interesting to get a sense from our class tonight where you're joining us from. So if you're comfortable just putting your location in the chat, as we get to some more of our state-specific programs like assistance programs, love to be able to share with you guys stuff that's available in your local market. So if you just want to put your location or your intention of where you want to buy in the chat, that would be awesome. We'll also take you through our buying process in terms of what does it look like to go from the classroom setting here and kind of put it into real time, right? What is it going to look like for me to start actually taking those next steps to home ownership? So I'm going to kind of walk you through the workflow of buying a home, and we'll kind of wrap up class with that last segment in tonight's session. Those of you that did put it in the chat of your intention of where you're buying, I appreciate that. Super helpful because we got a really pretty wide spectrum of locations. So that's really helpful for me. I'll keep that, bookmark that for our conversation tonight. So when we get to some of those areas around first-time buyer programs in your local market, we'll kind of make some comments around that. Okay, thank you for that, guys. All right, well, let's talk a little bit about not budgeting. We'll get to budgeting, but we're going to talk a little about does buying make sense for me? Because when we think about purchasing a home, it is a big financial investment, right? It's probably the biggest investment that you guys have even thought about so far. And so when we're considering that, we want to factor in a few elements that are really important to considering home ownership. Things like affordability, right? Now, we understand cost of housing is up there, right? But when we think about rent and the chances of your landlord increasing your rent, that is real. But when you're a homeowner, you have a fixed expense because you have a fixed payment on your mortgage. And for those buyers that are maybe purchasing in a higher rate environment, like we kind of sort of are right now, there will be opportunities to refinance their home at some point. So that is one of the big elements of, or benefits, I should say, in owning a home, be able to control your housing expense. This is an asset, and this is an asset that can grow over time. So as I pay down my mortgage on a monthly basis, as my home maybe goes up in value from where I purchased it at, that difference in those two numbers is equity. Home equity is probably one of the biggest assets for most owners across the country. It has the opportunity of creating generational wealth too. So, owning a home is an asset that can really work for you. There's also tax benefits of owning a home. In fact, I was just having that conversation with a client before tonight's class was, let's look at your tax bracket. Let's see where you're at. Can you create some tax savings for yourself by owning a home versus paying rent and, probably paying somebody else's mortgage that is renting that property to you? So, when you're thinking about home ownership, I would just challenge our class to maybe think outside a little bit in terms of, where you're at currently in your rental budget and, what could it look like for homeownership for me? And maybe I can, allow myself to move up a little bit in monthly budget so I can afford a home. Because when I factor in the elements like home equity appreciation, tax savings, it might be that difference maker for me. Now, to illustrate that point, I do want to walk us through a budgeting calculator. It's a rent versus buying calculator that we actually have on our website, as well as some other calculators that you guys can utilize. I'm going to screen share this calculator and just walk you guys through it really quick in tonight's class, because I think you'll find it really helpful in really illustrating the point of the tax savings, the equity appreciation, and really what it means to be a homeowner. Now, there's also some other great calculators you can take a look at, things like affordability, buying points to buy down your rate, monthly payment calculators. Maybe I'm thinking about refinancing one day. You can take advantage of one of those calculators as well too. But for tonight's class, we're going to go ahead and just take a look at this rent versus buying calculator. Quick side note for class, all of our presentation material, we're going to send back out to you tomorrow. So all the slides that I share with you this evening, we'll send right back out to you, include the links to a calculator like this. We also are recording tonight's class. So this will be up on our YouTube channel tomorrow. So if you want to look back at the recorded version, maybe you had to step away from your computer, that's totally cool. You'll be able to kind of look at the recorded version. In fact, all the classes we've taught to A&M over the last couple of years are all up on that channel as well too. So you can check that out at your leisure as well. So this is the rent versus buying calculator. We've already kind of pre-filled everything in just for time purposes in tonight's class. So it starts with obviously the home price. We put just an assumption around a $350,000 home price. 3% is the down payment, which you're going to find out in our product segment that's the minimum down payment for a first-time buyer. We have our loan amount, which would be essentially 97% of the purchase price. Average interest rate based upon that level of down payment. We have a 30-year fixed mortgage. Assumption that we buy our home in January. That's just kind of a what if. We have our mortgage insurance. So we're going to learn about mortgage insurance later on in tonight's class. But when I put less than 20% down to buy a home, I'm going to have mortgage insurance. And it's at a graduated scale of cost based upon your down payment, credit score, and how much you decide to finance. We have homeowners insurance cost, property taxes to the local county that you're going to purchase in. And you might be considering a condominium, maybe a townhouse. If you are, there might be HOA dues attached to the expense of that home. So we have a section for there. We didn't put a number in there for this exercise. And then we have someone that's in a 25% tax bracket. We have the cost of maintaining my house. If I eventually sell my house at some point in time, how much is it going to cost me to sell my house between realtor cost and closing costs for the home? Annual appreciation of my home factored in at 3%. And then this assumes a buyer that's paying $1,750 in rent, which is reasonable, I think, for most markets. Renter's insurance, and then the assumption that my rent will go up about 2 to 3%. We'll say 2% on an annualized basis. So what our calculator tells us, we have a break-even point, right? So at some point in time, I tip the scales where that it makes more sense for me to own versus continue to go down the path of renting. In this equation, it's 3 years. So that means it's profitable for me to be an owner versus renting at the end of 3 years. Now, that's a good number for us. We want it to be at least 4 years or less on a break-even point. But where I think it gets more interesting is we span out a little bit further. If we look at the end of 7 years, if I was continue to rent, I've now thrown away $157,000 in rent, right? And that's assuming my rent only goes up 2% in a year. If I'm owning, I've now saved myself $49,000 over 7 years by my equity appreciation, my tax savings. I'm now having an asset that's working for me. And that's just after 7 years. So clearly there's a massive difference between renting and owning. Now, if I was to say I want to be in this house for 10 years, right? That's $91,000 in the gain opportunity of buying versus renting, okay? Now, I know everybody's situation is a little bit different. Our intent is not try to sell you on homeownership with a calculator like that. It's really to inform you, because I do think a lot of consumers are a bit misled at their budget by just trying to map a mortgage payment to a rent payment. And it loses their buying power because they don't really know about the elements of ownership that really make up all the key benefits really of ownership. So that's a calculator that I really would encourage our class to take a peek at when you have a free moment. Now let's talk a little bit about the housing market, because I think part of your entry or timing of entry to the market is going to be, what's the housing market? Well, for many of you that are in Texas, and I saw a lot of you in the chat that are joining us or plan to buy in Texas, I think that's probably about 80% of you. Texas is one of those markets that is a very safe, it's a very buyer-friendly market, we'll say. We're seeing excessive supply on market. We're seeing average days on market tick up to 70 days in the Texas housing market. Texas is one of 4 states that has the most amount of supply on the market right now. That also includes a few other states that I think we have some intent to buy in, which would be Colorado. That also includes Georgia, and that also includes Florida. So those states really are the most appealing for buyers. So a lot more negotiations are happening there, a little bit more buyer friendly when we think about, the ability to negotiate credits from sellers towards closing costs. So all of that's attributed to there's lots of supply, demand's okay, but homes are just staying on the market longer, right? You can see the median home price in Texas has dropped by 1.4% year over year. And you can see our graph kind of outlining that as well too. We'll give you some market trends as well to kind of take a look at. But as we look at 2026, the mortgage industry and the housing market for that matter is calling for a little bit of a reset. Home buying should be a little bit more affordable this year because interest rates are going to slide a little bit. Not a ton, where there's little nuances in the market. I do think we'll reach, below 6% this year. We might get as low as 5.5%. We'll just have to see what happens. We're not expecting any big kind of price growth in sales prices this year. Many areas won't see any big jumps at all. It's just more kind of stabilization, and we might see some dips in the market, just like you've seen in the Texas market. So those markets that have a little extra supply and demand is not really super strong. That's where you're starting to see those softening of prices out there. Now, in inventory, supply conditions might improve slightly in some, different markets. We are seeing builders trying to build to get some more supply up, because there are markets across the country, California, for example, that there are areas more in the densely populated areas that just don't have enough inventory. I think I had San Diego represented here in the chat, which is, that's a market that's super hyper competitive, right? There's just not enough supply. Prices are still rising in that market. A lot of people relocating to the San Diego market. And of course, who wouldn't want to move to San Diego, right? But with that comes, higher home prices. So, that's kind of a look at what 2026 looks like. I will say, when I look at just our activity, buyer activity year over year, so I compare January 25 to January of 26, much more active market. We have about a 40 to 50% buyer increase right now, just engagement of just, hey, I want to understand my options to home buying. I want to be prepared, because many buyers are trying to get into the market before the spring buying happens. So seasonally, the market gets hotter in spring and summer. That's when we see most of the buying occur, because let's face it, in many parts of the country, those are you in the Midwest or on the East Coast where we maybe have some colder climates, like you're not going to want to jump in your car and go look at, homes in 18-degree weather, right? So, as the weather starts to get a little bit better, maybe we're also thinking about school districts for family and stuff like that. That's when we generally see the housing market start to heat up a little bit. Here's the Texas housing market forecast. So you can see kind of what's going on, with the challenges we've seen in supply, kind of like staying or stagnant on the market with 7 days. We do see some potential price growth going from 25 to 26. So, more buyers will probably re-engage in the Texas market. As an example, sales volume increasing 2% to 3% in 2026. Of course, we talked about mortgage rates, and we'll talk more specifically about some trends in mortgage interest rates. Housing starts, that means new builders starting to build, going up by 1%. Rents kind of just going up a bit, but not a huge increase. And then inventory is going to still be elevated. And I kind of already alluded to this already, more buyer friendly. So it was a buyer's market in Texas. Q3, Q4 probably can continue that way in 2026. And again, those other four states or other three states I mentioned, very, very similar trends. And so I think most of those markets are represented in tonight's class. Now let's talk about interest rates, because that's probably one of the bigger conversations I'm having with clients, strategies around what's going on with interest rates that may, drive some of your decisioning process to purchase a home. This is a look at interest rates the past 3 years. Now we have a longer look just below here. Interest rates have certainly, had their share of issues over the last 3 years. We finally hit a 2-year rate low just about a week ago. We actually kind of just fell right slightly below 6%, but that's kind of ticked up a little bit since then. And so, we're really watching interest rates, especially in this kind of geopolitical environment, what's happening globally, economically, because it does influence interest rates. Interest rates change every minute throughout the day. So, somebody says something in the markets, whether it's an economist, somebody speculating on the markets, somebody in the administration says something, someone says something in Europe. Those have impacts in really what is a global economy these days, and it does impact us at home in our interest rates. Beyond that, the Federal Reserve is monitoring what's happening in two kind of like economic indicators. One is they're looking at what's happening in the labor markets, things like unemployment numbers. They're looking at, how many job openings are there out there, but they're also looking at inflation. They're looking at what is it costing us at home, on everything from energy costs to goods. The goal of inflation is to be at 2% for the Federal Reserve. We're still above that. Inflation, we call it a core PCE report come out today. It was right in line with numbers, and it didn't really move the markets. Because if we can get indication that we're going to see softer inflation, we're probably going to see the Federal Reserve make another move on an interest rate cut. When we think about a pending interest rate cut by the Federal Reserve, you will see mortgage interest rates slide lower in anticipation of that. So as we get more clarity that the Federal Reserve is going to cut interest rates, you'll start to see mortgage interest rates slide. So right now, we just don't have data that would say, yeah, the Federal Reserve is going to make another rate cut at this point. As we get more clarity on that, as we kind of see what's happening in the news, interest rates will kind of follow suit to that. Now, interest rates are not the same for every buyer. And I think that's important to understand, because things like credit and eligibility factors for your loan will make up your interest rate, the product you select, how much you finance, what your down payment looks like. Some of our clients will choose to buy down points on their mortgage, which basically means I'm paying out-of-pocket expenses in order to bring down that interest rate. Not something I would recommend for buyers, because it usually has about a 4-year break-even point. So unless you have to really achieve a low payment because you want to afford that particular house, I don't recommend doing that, because most of our clients, if you're choosing to buy in today's 2026 market, you're probably going to refinance in a couple of years, because if you bought today at 6%, rates will probably be at least 1% lower in a couple of years. But ultimately, it's our job to kind of figure out the right option for you as we meet with you for a consultation. That's one of the things we do with our clients, just to make sure they have customized options to meet their financial goals. One other thing I wanted to point out to you with interest rates, the term of my loan can also influence my interest rate. So if you move from a 30-year loan to a 15-year loan, that can also lower the cost of interest. Not something that most first-time buyers are going to do, because for most of us as first-time buyers, we're trying to get the lowest monthly payment, right? And a 30-year mortgage will afford us that opportunity. All right, well, credit was one of the big items that plays a role in interest rates. Credit can also impact cost of the mortgage insurance that you pay for your loan. Like I said, the product type that you have available to you, and of course, that interest rate, like we just mentioned. Every loan program has a minimum credit score. You can see those on screen. And we think about the credit score that we look at as lenders. We always take the middle credit score of all three bureaus. And you guys know the name of the credit bureaus, it's TransUnion, Experian, and Equifax, right? So they all have their own separate risk models. They report out a score, but you probably didn't know there's also 3 different models to scoring. There's credit card model, which you'll find in your Credit Karmas or your consumer monitoring of your credit report. There's auto financing, so that has its own separate credit model. And there's also mortgage model. So oftentimes when clients will come to me for their consultation and review their credit, they're like, hey, Jason, Credit Karma says I'm 790 on my profile with them, but you said I'm 760. What's the difference, right? The reason why is because we're looking at different models of credit. Now, we also look at the middle credit score of all three agencies reporting. So if my highest score is 800, my middle score is 780, and my lowest score is 760, we're going to use 780 as a score that we'll use to measure the product that you're going to get access to, of course, the interest rate and the mortgage insurance. That's called the middle score that we take. Now, if you're applying with your partner and your partner's middle score is 760, well, that's 20 points lower. That might change the interest rate offering or maybe the mortgage insurance that you pay. So we always go off the lowest middle credit score between both borrowers in financing. When we think about impact to our credit score, if I've had some challenges like a late payment or some hard inquiries, if I've had anything on my credit in the last 12 to 24 months, that's when I'm going to have the impact to my credit score. As I move organically away from that, like delinquency of maybe a student loan payment, then I start to see my credit score improve over time. But in the most recent 12 to 24 months, that's when I'm going to have the impact to my credit score. All right. Now we're going to talk about the mortgage model of credit scoring in just a second. We're going to highlight maybe some areas of opportunity for your own specific credit score. Before I do that, though, I wanted to give you a matrix that kind of shows you how long some of those negative items will stay with you on your credit report. So if you do have a delinquent credit card in the past, right? Let's say it was 12 months ago. Yeah, maybe it's impacting my score a little bit right now, but over time that will season out of my credit score. But this is how long the late payment will stay with me on my credit report. So it'll image on your credit report for 7 years, but the impact to my credit score will be in those recent 12 to 24 months. So I had a question coming in the chat, and then I'm going to go over the mortgage score calculation in just a second. But the question was, how can you calculate the number for the mortgage calculations? I think, can you expand on that question for me? I thought I was reading it one way, but if you can just kind of elaborate a little bit more on that question, I'll answer it. If you're speaking of a mortgage calculator or maybe the mortgage score model. So just let me know more about that, because we are going to talk about the mortgage score model right now when it comes to housing, right? So there's like 4 different elements to the mortgage score model, and it looks like this. So we have length of credit. So the longer I've had my credit profile, the more mature it is, basically, the higher my credit score could be potentially on my credit. How much new credit am I trying to access will also impact my credit score. So I want to really reduce the number of accounts that I'm opening up, especially in the most recent 6 to 12 months. That will also be inclusive of inquiries. I really want to reduce how many inquiries I have. Now, in our process in evaluating your mortgage options for you as our client, we only start with a soft credit score. And the reason why we do that is because soft credit scores don't impact your score at all. But there are rules in place for lenders that do hard inquiries that basically mean that if you do a hard inquiry specific to mortgage, you have a 30-day window of time to shop around with as many lenders as you want. And it's the equivalent of 1 credit inquiry hit to your score. And on the auto financing side, the same rule applies. You have a 30-day window of time to shop around with lenders. Okay. Okay, so I want to follow up on this question that we had in the chat. If the credit score you see is different than what you might see on Credit Karma, how can we know what my score will be used for a mortgage? Okay, that makes sense. So the question was, if I have a Credit Karma score that's X and my mortgage score is Y, how do we know what the Y looks like, right? So there are tools like Experian, for example, allows you have to upgrade your membership, but you can see all 3 different models to scoring. Experian is one of the tools I use. But of course, as we go through a consultation with you, we pull a soft credit check. We're going to report back to you what the soft score looks like for you in the mortgage space. So, if you're a high credit score customer, so if you're 760 or above, not going to see a lot of variance. I think if you are, repairing credit or you have areas of opportunity on your credit and you're trying to get to some of those minimum levels for qualifying, that's where, every point's going to make a big difference for you. But, that's where you'll see those subtle differences in credit scores just because of the model. Now, as we move along here, we have amount owed. Now, we're specifically looking at revolving accounts. So it's credit utilization. So how much am I accessing of available credit limits that are available to me? So if I have $10,000 in credit limits and I've charged up $8,000 in balances, I've used most of that credit limit, right? So that means I'm at 80% utilization of credit. That also means I probably had some pullback in my credit score. So our action item for one of our clients in that situation would be, hey, let's try to get those balances down to like $5,000, right? And then we'll see an uptick in the credit score. Then the next step would be, let's get to 30% utilization or $3,000. And then the optimal level, so more oftentimes when we see clients at 800 plus credit scores, they're at probably 10% utilization or lower. Okay. Now, here's my tip for you tonight to try to manage down credit card debt and maximize your credit score. So if you look at one of your credit card statements, you have a billing statement date and a due date. The billing statement date is the date that the credit card issuer closes out all of the activity from the preceding 30 days. So my tip for you is if you could pay off the balance or at least pay it down, like we recommended to at least get to 50% utilization, if you can pay it down before the end of the billing statement date, what happens is before the cycle closes out, the credit card issuer will now send out a lower balance to the agencies, along with your payment history, your existing credit limit. And when they report out to the credit agencies, now you have a much lower balance that's going to improve your utilization of credit and then, of course, raise your credit score. So especially if you're getting ready to make a major purchase, like, of course, buying a house, probably a good action to take. Now, we'll also credit coach you through that too as part of your consultation, because when we work with clients, it's not a pass or fail type of situation. I'm going to customize options for you and figure out like what could work best for you based upon our discussion around credit in general and, of course, different product options. Last thing is pretty self-explanatory. That's payment history. So that has the biggest impact to my credit score, as you can imagine. If I've had late payments, again, especially in the most recent 12 to 24 months, that's going to be the largest impact to my credit score. And late payments are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The more severe on the spectrum of lates, obviously bigger impact I'm going to have to my credit score. Now, one of the things that comes up on credit, as you can imagine, is student loans. And for those of you who are in active repayment on your student loans, that's totally fine. We can use that payment right away. That's called an income-based repayment plan or savings plan, depending on who your student loan provider is. But that payment or that option is not always in place for some of our clients today. Some are still in forbearance. Some might be in deferment because maybe they're back in school or whatever the case may be. So I think it's important to understand as you're getting ready to apply for a mortgage, give you a little bit of perspective of how we look at things from the lending side of things. So of course, if you're on a savings plan and let's say you do have that $75,000 in student loan debt and you're paying $250 per month, that's the payment we're going to use to qualify you today, right? Now, if you're not in the savings plan today and you're applying for an FHA loan, then we use 0.5% of the outstanding balance as the monthly payment. So that would be $375 per month in qualifying. If you're doing a conventional loan like a Fannie Mae loan, we take 1% of the balance and then we use that as the payment. So that's an important conversation that I'm going to have with you just to make sure that in budgeting your student loans into the equation for homeownership, that's still going to feel affordable for you. But of course, make sure that we qualify okay. So that's just an important thing to look at. Now, if you're in public forgiveness program, so if you're working as a public employee and you have a 10-year forgiveness program, if you're in year 5 of that 10-year forgiveness, we still have to count the minimum payment for qualifying today, even though we know it's going to be forgiven at the end of 10 years. So really, it's going to be most impactful in student loans if they're not really in repayment and you're on a forbearance or deferment, because then we have to use that calculation, as I mentioned. All right, the reason why we apply that calculation, because when you think about loan programs for home purchasing, there's guidelines that are attached to those. Basically, how we need to look at income, assets, credit, expenses versus income. All of those elements go into the guidelines of loan programs for lenders that are offering products. And so I'm going to walk you through some of the core products that are available to you as home buyers. And a lot of the terminology I'm going to share with you, you've probably heard before, but hopefully I'm going to be able to kind of put the pieces to the puzzle together for you, because some of the terminology you've probably heard in the news and don't really know where the application is at with that. So a conventional loan is going to be around Fannie Mae and Freddie Mac. You've heard them in the news, especially over the last year. They're talking about dissolving Fannie Mae and Freddie Mac and privatizing and all that stuff. They also came under a lot of scrutiny in the housing crisis, right? And so you saw back in 2008, a lot of scrutiny there. And then they've kind of been under conservatorship with the U.S. government. Fannie Mae and Freddie Mac does have a minimum down payment of 3% on for a first-time buyer. There really is no minimum credit score for Fannie Mae, although we have 620 on screen because that's for more Freddie Mac. There's more of a risk assessment that they look at in general. Every year, there's a conforming loan limit that's set by FHFA that sets the conforming loan limit based upon the cost of living annually. So right now, it's actually gone up to about 832. If you're in a high cost of living area, like we'll use San Diego again as an example, we can go up to higher loan amounts in those markets because they're higher cost of living areas. But we do have to increase that minimum down payment from 3% to 5%. So that's one of the trade-offs with a higher cost of living product. With a conventional loan too, it can also be coupled with first-time buyer programs as well too. And we'll talk more about that in just a bit. FHA is going to be a government insured loan. FHA stands for the Federal Housing Administration. Minimum down payment of 3.5%, does have the minimum credit score of 580. Now the loan amount's a little bit different because it changes based upon the county that you're going to buy in. So you might have one county in Texas that might look a little bit different than a county in Florida, for example, with FHA. Now both FHA and USDA are government insured loans. And there were some changes as it relates to residency in or resident status in the U.S. with those two products. About 4 months ago, unfortunately, some changes were made that you do have to be a permanent resident to access either FHA or USDA. You can still be a non-permanent resident to access a conventional loan, but unfortunately, on any type of government insured product, you do have to be a permanent resident. USDA is a zero down payment loan. It's USDA is just like you would expect the United States Department of Agriculture. It's designed to support buyers that want to buy in more rural communities. And with that zero down payment option, there is two qualifiers, has to be designated as rural, and you have to meet the minimum or maximum income limits based upon your household size. The jumbo loan that's shown up at the top of the screen, that's really going to be for clients that need a little bit more buying power because maybe they're buying in a high cost of living area and it stretches above some of the agency limits. But it does come with higher down payment requirements, higher credit score requirements. And then finally, the VA home loan is a loan for our veterans to help serve them in home ownership. Zero down payment option, a little bit more flexibility in the guidelines to provide that support for the veteran. Lower credit score minimums at 620. There really is no maximum loan amount for the VA home loan, but the big aspect of a VA loan, it is a zero down payment option. All right, now we're going to dive into PMI, which is private mortgage insurance, but we're also going to talk about mortgage insurance premium as it relates to an FHA loan. Before I do that, I just want to check any questions from our class so far. I know I've thrown a lot of terminology and concepts at you, so I just want to make sure that I'm not moving too fast for our group. And again, we are recording tonight's class, so if you missed something or need to do a look back, you'll be able to kind of check that up on our YouTube channel again tomorrow. All right. I think I'm good. Okay. Let's talk about mortgage insurance. Mortgage insurance gets a little bit of a misrepresentation in the marketplace. But what is mortgage insurance? What does it do, right? So PMI stands for private mortgage insurance. It essentially provides insurance that insures the lender against default by the buyer. So if the buyer was to go through an economic hardship, couldn't pay their mortgage, the PMI company basically insures the lender against that default. MIP or mortgage insurance premium is the same type of mortgage insurance. The difference is it's not provided by a private company, it's provided by the government. It's provided by the Federal Housing Administration. So those are the differences. And there are different premiums for each product. So on a conventional loan, the premium that you pay as a buyer is based upon down payment, credit score, and then how much you finance. So the more I can put down, the higher my credit score is, the less cost I'm going to pay from a mortgage insurance perspective. One of the key benefits of conventional mortgage insurance is that when I reach 2 years in my loan and I have 20 to 22% equity, I can apply to have my mortgage insurance canceled and I don't have to refinance my home. If you were looking at an FHA loan, alternatively, the only way to cancel your mortgage insurance on an FHA loan is you have to refinance from an FHA loan to a conventional loan. And of course, you wouldn't want to do that until at least you had 20% equity. On the conventional loan, when we think about the dollar cost on a monthly basis for a conventional private mortgage insurance, let's say you were financing $300,000 and you had a 740 credit score and you're putting 3% down, you're probably about $92 a month. If you're on some calculators like on Zillow or maybe Redfin, right, you might see a much larger inflated number because it's not really calibrated to the three characteristics that I shared with you earlier: credit score, down payment, amount financed. So mortgage insurance gets a little bit of a bad rap because everybody's working really hard to get to 20%. It's not achievable, obviously, for everyone. And so it still can be accessible for homeownership and reasonably priced. And those are conversations we'll certainly can have with you during a consultation. Now on the FHA side, it's a little bit different because there's two aspects to mortgage insurance. There's monthly mortgage insurance, which is calculated at 0.55% of my total loan amount. And we divide that by 12 to figure out your dollar figure. And then there's upfront mortgage insurance, which is 1.75% of my loan amount, which gets added into your total amount financed. So when we think about the cost of mortgage insurance for an FHA loan, it is rather expensive, comparatively speaking, to the conventional loan because the upfront mortgage insurance is like $5,200 one time for the FHA loan, and the monthly mortgage insurance is about $40 or more per month. Now, I think it's important to understand that not everyone's going to qualify for the conventional loan, so we might have to look at FHA because FHA is much more flexible from a guidelines perspective. If I had that late payment on my student loan back in October of 25, I totally slipped it. FHA would probably be okay with that. Conventional loan might be a little bit more challenging to get financing. Maybe I had a bankruptcy that's 2 years ago. FHA would be okay with that, where conventional wants to see 4 years out of a bankruptcy. All right. So as we customize home buying options for you, we're going to figure out which product matches up ultimately best to you. Now, as we kind of continue in our discussion tonight, I want to cover income, and then we're going to look at income versus expenses. I get a lot of questions around employment or sources of income that can be used. So we always like to share that back in our classes. Before we go through some scenarios for you, I did want to provide you with the general documentation that you'll need as you go through our consultative process. If you want to kind of design a home buying plan for yourself, things like 2 years of W-2s, recent pay stubs, 2 months of bank statements, all of those are kind of the basic items that we generally ask for as we prepare you for your consultation. Let's talk a little bit about employment scenarios because I think there's a little bit of misrepresentation as it relates to, who's eligible for home financing. Do I have to have a certain amount of time on my job? And what it looks like is that I have to be able to at least verify 2 years of work and or educational history in order to apply for a mortgage. So as long as I can put that together, then I could potentially be eligible for financing. So I don't have to be on my job an extended period of time. In fact, let's say I just started my job January 1, right? I just graduated from A&M in the fall, got my new job. I'm ready to go, hit the ground running for this year. Well, I could potentially qualify for a mortgage just with starting my new job and to show my undergrad at A&M to be able to make up that 2-year requirement. So not necessarily something I have to be on my job for a certain amount of time. Now, if I have variable income sources, let's say I signed on with Google and Google's giving me my bonus, and also I have my shares that I get as well too. In order for me to count those variable sources of income, I do have to show that I've been on the job 2 years in order to count those variable sources, because in lending, we calculate an average income for those type of variable sources for 2 years. So that's what we're going to look at to determine eligibility. Now, if I have income like from overtime, that would also be a variable source as well too, because I'm an hourly employee. I get paid my hourly wage plus obviously my hourly amount as well too. That case, I also have to show that I've been on the job 2 years in order to count that overtime. And then as your lender, we would average those hours over those 24 months. If I'm self-employed, I do have to show that I've filed 2 years of taxes in order to be eligible for financing, because in self-employed individuals, we take the net income on your taxes and we use that as your calculation for our income in qualifying. All right. I also get some other questions around dual employment. So I have some clients that have maybe a 30-hour-a-week job and then maybe a 20-hour-a-week job. So those are technically part-time jobs. If I can show that I've been on both jobs simultaneously for the last 2 years, we can use both sources of income. And finally, just want to give you one other thing that comes up quite a bit is that we have clients that maybe work for Uber or Lyft on the weekends and also have their 40-hour work week job. We can certainly count Uber and Lyft income. It is 1099 or independent contractor income, but that is also a case that we have to show that we've been on both jobs simultaneously for the last 2 years. All right. One of the questions I got in the chat, I'll just kind of share back with the audience. Can we include our 401k, equity investments, or uninvested company stocks? And I think your question is around income. So there is ways that we can show or amortize out assets as income. We call it asset depletion in financing. So yes, you could potentially do that. And then if you have, I know this question is unvested company stock, but if you had vested company stock, we can take a 3-year average of the price of that stock. So let's say you have restricted stock. We can take a 3-year average of that. We do an amortization calculation, and then we can plug that in as future income for qualifying. So one of the things we also look at is income versus expenses, and we call that measurement debt to income ratio, which essentially looks at your pre-tax income versus your expenses, things like personal loans, credit cards, auto payments, but it also factors in what your new housing payment's going to be. So when we think about our new housing budget, that includes the principal and interest of my loan, property taxes, homeowners insurance. Maybe I'm paying mortgage insurance because I'm putting less than 20% down. And if I'm buying a condo or maybe a townhouse, there's probably going to be HOA fees. So we take those expenses versus your income, and we have a percentage that we want to make sure that we don't exceed. So if we look at our calculation here on screen, assumes a buyer that has $2,500 in housing expense, $500 in other expenses, and they're making $8,500 a month. So that shows us that $3,000 of their pre-tax income is going to be consumed, $3,000 of expenses will consume their income, or 35.3%. So the expenses cannot be any higher than 45 to 50%, depending on the program. Obviously, that's really on the high side. Most first-time buyers, especially, feel really comfortable if that debt to income ratio is around 33 to 36%. That's kind of the sweet spot or comfort zone for most clients. Okay, another question I got in the chat, which is, if we have a diploma and sign the job offer, but don't start work for a couple months, is there any, am I still eligible, missing 60 days of pay stubs? Great question. I'm glad you actually answered that, because that's actually one of my scenarios I like to share too. So yes, you could actually get qualified for a mortgage with an executed offer letter. Now, that would allow us to get the pre-approval going for you and for you to start your home shopping. Now, as we get further down the stages of the buying process and you have identified a home, then we want to make sure we get it executed with any non-conditional offer letters, like with your official start date, that you passed background and everything. And theoretically, we can actually close escrow on a home even before you've started on the job. Okay, hopefully that makes sense. Let me know if I need to kind of clarify that a little bit more for you on your question. All right, so that was a little bit about income, of course, about expenses and how they relate to each other in the qualifying of a mortgage. Last thing we want to talk about before we go into the buying process and wrap up tonight's session is to just go over down payment, because that can be one of the more challenging things for some of our buyers, just because maybe we're new in our job, or we're trying to get through some student loan debt, or just get our financial footing going, right? So when we think about savings for home ownership, there are different asset accounts that can be used. We can't use cash accounts or cash, I should say, but we can use accounts that have seasoned monies. It has to be at least seasoned 60 days. Things like checking and savings accounts, 401ks, 403bs can be used, brokerage accounts. Those all can be used. I would always encourage our clients, talk to your tax and your financial advisor before you get into some of those assets and liquidating those. Gift funds can also be used in a home purchase. Those do not require any type of seasoning. Gift funds are where a family member has contributed funds towards your home purchase. And that happens quite often, honestly, with a lot of home buyers. One of my clients' consultations earlier, we having that exact same conversation, where you're having maybe a family member that's contributing, let's say, $10,000 towards your home purchase. Absolutely allowed in the underwriting guidelines. So as we think about savings being a challenge, so often I'm coaching clients on how do I get myself in a better position? So maybe buying is more of a near-term goal for us. So we've, over the last couple of years, just developed a really easy way of kind of thinking about savings for home ownership. And we call it just our savings plan. And it looks like this. So if you're paying $1,500 a month in rent, right? You started your new job, you got some good income coming in, but you're still kind of working through some credit card debt or student loans, but you feel like the target number to buy a house is $3,000 as a mortgage. Well, there's a $1,500 gap right there, right? So what I would encourage our clients to do is let's do our best on the first of the month when we're paying that rental payment to our landlord of $1,500. We create that habit monthly that we're going to transfer that other additional $1,500 of surplus into our savings account on a monthly basis, right? Creates that discipline of saving on a monthly basis. And before the end of the year, or by the end of 6 months, we'll say I have $9,000 accrued in my savings account. By the end of the year, I have $18,000. And now I've kind of built up a pretty good resource of funds for my home purchase. I can't tell you how many clients have applied that type of approach and really been successful with it. It's super easy, but it just creates that discipline of savings. But also, it also kind of like acclimates you to being able to take on that mortgage payment when that time comes that you're actually purchasing that home. All right. So that's a little bit of our savings plan. I do also want to point out first-time buyer programs, like I mentioned to you earlier when we kind of launched into class, because first-time buyer programs can also make homeownership so much more of a near-term goal for you. So I'm going to spotlight a few programs within Texas, and I know we have some other states represented. So I'll kind of go over some high-level stuff at some other states. Before I do that, let me just take one more question in the chat, which is, how does leveraging a brokerage account work for a down payment rather than liquidating them? So you have to talk to your institution that you have your funds with. Sometimes you can do margin accounts where you're basically borrowing against the asset. Let's say I have $100,000 in a brokerage account. They may let you borrow, let's say $50,000 on the margin of that asset. But every institution's a little bit different. Let's take a 401k, for example. 401ks are absolutely allowed in borrowing funds. We don't count the 401k payment against you in your debt to income ratio. So that's absolutely allowed. And you're taking money or borrowing money against your asset, right? Trade-off to that is when you borrow money against the asset, you're also pulling the money out of the market, so you lose the appreciation. But yeah, I mean, I would say for those of you looking at like your brokerage account and leveraging that, I definitely have a conversation with your financial advisor or your institution that's managing the money. Another question is, how does it work with a Roth IRA? Very similar. There are IRA programs where you can borrow against a Roth IRA but for institutional financing like I'm offering, and you do want to talk to your tax and your financial advisor, but the potential to be able to access your Roth IRA penalty-free as it goes into a home purchase may be an option for you, but you definitely want to talk to your financial advisor. But you're essentially trying to liquidate that asset to fund your down payment. So in Texas, we've had a lot of successful closings with the Texas State Affordable Housing Program. I don't know if you guys have got a chance to take a look at that, but that's a great program that provides up to 5% in down payment assistance. And what's nice about that, it's a deferred forgivable loan that depending on which program you elect at a certain point in time, that assistance that you receive from TSAHC is actually forgiven to you. And there's also special incentives for military, first responders, teachers, and then also, which is very unique because it's not applicable in most parts of the country, is called a mortgage credit certificate, where you can get up to 15% of the interest that you pay on an annual basis back in the form of a tax credit. So it can be a really great opportunity for you. And we've got a chance to do several transactions actually for some of our A&M community with that program. So love to be able to share with you more about that. Now, Freddie Mac and Fannie Mae also have special programs designed to support first-time buyers, a lot of which are for low-income buyers. So if you make less than 80% of the median income, then you would qualify for some of these programs. We also offer what we call a 1% program, which if you were doing a 3% down conventional loan, obviously it's a 3% down minimum. If you contribute 1%, then APM would grant the other 2% up to $4,500. So let's say you're buying a $250,000 home, right? Well, the down payment is 3%, which would be $7,500. If you contributed your 1%, then we would have another $4,500 that would be granted into you to almost cover that entire 3% down payment. So that's a great program that we offer as well as the Pathway DPA program. That's more of an FHA program. That is also a national-based program. So the question was, what is MCC? As we have on screen, so MCC is a mortgage credit certificate. So what that is, once you participate in the MCC program, that MCC stays with you for the duration of your ownership. So let's say I buy my home with the TSAHC program at 7% interest rate today, and I have the MCC. Well, I'm getting a 15% tax credit on that 7% interest annually. 5 years later, I refinance down to a 4% loan, right? That MCC can be reissued and still get a 15% tax credit, but it's now based upon the 4% interest rate at my new balance, right? So really a nice resource to have as a first-time buyer. Obviously preserve or create tax savings for yourself. So a really great opportunity with that first-time buyer program. Now, I saw California was represented. California, we work with Cal HFA, which is the California Housing Finance Agency. Our team is the #1 provider of the first-time buyer program in California. There's a lot of great programs there. I'm going to have Ken pass along the link to you for Cal HFA because there's the My Home Assistance program, which provides 3% of your sales price in assistance. There's also what we call the Dream for All program, which is a lottery-based program. It's designed for first generational buyers, providing up to 20% of your sales price or 150,000, whichever is less. Ken just put that information in the chat. You can check that out, see if that's applicable for you. But at the end of the day, most of the first-time buyer programs, you have to be somewhere between 120% of the median income to less than 80% of the median income to qualify for those programs. Okay. And I think I saw Illinois represented. There's certainly an Illinois first-time buyer program available for you. Maryland, we have one as well too. So I would say for our class, let's try and touch base. If you are interested in some of those first-time buyer programs after class, we can walk through some of the specific guidelines, see if they're applicable or they work best for you. And I did mention income limits. The income limits are based upon county limits. So there's established income limits all across the country for each county. So there's an 80% threshold, 100%, and then 120%. So most first-time buyer programs will go off of 120%, and then obviously below 80%. California does go to 150% just because it's a higher cost state. So I hope that answered your question there. All right, so I want to make sure that we cover the buying process because I get so many questions about, where do I start? Where do I go? I'm really thinking about buying a house, but I just don't know where to begin. So obviously you've attended a class. Hopefully you've got a lot of great takeaways from tonight. I've really enjoyed presenting this content, but where do we go from here, right? And from this class, we kind of go more to the real-time session, which is we would love to connect with you for a consultation to design some home buying options for you, which is a free service we provide to all of our communities we serve across the country. So that consultation allows us to meet for 30 minutes, design some home buying strategy and plan, and then we issue a pre-approval. Now that pre-approval can be used right away. You can go look at homes this weekend, or it's something that you just have a baseline for your eligibility. And you're like, hey, I'm gonna look later on this year or maybe next year, right? But you get a baseline of eligibility. But a pre-approval is good for 60 days, but we can always recertify it at any time. We're going to tailor that pre-approval to meet your needs. So if you get pre-approved for $450,000 for a place out in Houston, and you're like, gosh, I really love this house for $415,000, we can always customize that down to $415,000. Or maybe you're trying to go to the $475,000 level and you qualify, we can always adjust those numbers accordingly. So that's step one, pre-approval. Step two is house hunting. So that's where you're going to probably start online with your search, look for some different communities that have all the key elements that are really important to you on your move. Maybe it's, the school districts, maybe it's the walkability, maybe it's the restaurant scene, whatever you're looking for, right? All of that stuff will probably start with online. When you're ready to connect with a realtor, that's when you kind of start getting in the car and going to open houses and doing all that stuff. Realtors are a really important resource for you in the home search. We have a preferred network of realtors that we can connect you with as part of your home search. But that would be step two in the process. That house hunting could take 2 weeks, could take 2 years. Just depends on what you're really looking for. But let's fast forward a little bit. Let's say you find the home of your dreams and you're like, this is it. I love it. Let's go for it. You submit that offer to the seller. The seller says, yes, I'm going to accept your offer. In fact, we had an offer just accepted in Houston just a couple of days ago, I believe. And now that process begins in that transaction. So that means we're now at step 3, which is entering escrow. You have an agreement with you and the seller saying, this is how much I'm going to pay for the house. These are my timelines to execute. And these are all the key aspects of that contract. Well, the day I get notice that you have your offer accepted, I'm going to give you a call and say, hey, congratulations, you did it. Your offer is accepted. Let's talk through some next steps for you. Let's talk about some timelines. Let's set up some time for you and I to do a video session just to go through all the numbers of your home purchase, just to make sure you really feel comfortable with everything. And we'll kind of milestone everything out for you. That kind of gets things rolling. You'll have a checklist of items that you'll be putting together as we prepare for some of the administrative functions in the loan. So we'll get together for that 30 to 45 minute session. We'll provide disclosures to you. We start talking a little bit about interest rate strategy because if you remember during our interest rate discussion, interest rates change throughout the day. So we really want to be strategic in when we lock in that interest rate. So once you're under contract with the seller, Then we start talking about, when the time is right to lock in that interest rate. Part of the contract includes making an earnest money deposit on your home purchase. Generally, in most parts of the country, that deposit will be somewhere between 1% to 2% of the purchase price. Okay. And so that'll be part of that. The deposit you make, it's basically a good faith deposit that goes towards the home purchase, goes towards your down payment, your closing costs, all of your total out-of-pocket expense. Now, in most contracts across the country, there's a thing called contingencies, which protect that deposit, that allows you to get things done like your appraisal to support that the appraised value matches up your purchase price, get your inspections done on the house, make sure the loan gets approved, make sure all your financing is all checked off, right? All those things are done. Contingency timelines vary depending on what part of the country you're in. I would say on average, they're probably in the first 10 to 21 days of the contract period. Now, to go from step 3 here, which is enter escrow, to get the keys to your house, it's about 30 days in most parts of the country. Now, you might get into some hyper-competitive climates that are going to be quicker than that. Could be 14 days like we see in some markets that I support across the country. But on average, it's about 30 days. So as we move through this workflow, step 4 is the administrative task of your loan. We verify employment, make sure your product's set up correctly, obviously providing disclosures to you throughout the process. We're verifying employment, assets. All of those things are really important because what we're going to do is get everything prepared for the underwriting process, which happens usually in the first 7 to 10 days. The underwriters will then approve your loan. We'll have that approval issued to you. There might be a few conditions that you'll be involved in helping us, because underwriting is the credit risk side of the business to make sure everything is all buttoned down correctly. Once that approval is issued, we have all of our conditions. Then we're going to issue a final closing disclosure to you. That is after your interest rate has been locked in. So there's 3 sets of disclosures that go out to you in the process. There's your initial disclosures within your a couple of days just after your follow-up consultation. After we lock in your interest rate, there's your redisclosures. And then at step 5, you'll get your final closing disclosures for your 3-day cooling off period. And then after that cooling off period has elapsed, then we get to the very final milestone. We call that the closing of the home loan. That's the date of the signing of final loan documents. Now, in the loan process, everything can be done electronically, but at step 6, it's still a little bit of an old school process. You do have to get in person with a public notary or an attorney or title officer or escrow officer, depending on what state you're in. You sign final loan documents. It take about an hour, maybe an hour and a half, depending on the product. That same day, you'll also wire in final funds for your home purchase. And then as your lender, will also wire in the funds for the home purchase as well. So that money gets all reconciled or balanced with the escrow office or attorney's office. Then documents will get recorded with the local county recorder's office to transfer ownership and record the deed for the loan. And guess what? You're done. At the end of that, you now have become the official owner. I get a chance to call you and say, hey, congratulations, you did it. High five. You went from a classroom to now getting the keys to your house. Several of your fellow alum have done that exact same thing, and it's a really cool moment. It's a huge accomplishment. Now, our relationship doesn't end from there. Part of our aftercare is staying with you and kind of updating you on what's happening in the market from a rates perspective with our Rate Watch program, providing you tools like HomeBot to manage what's going on with home equity, because remember, this is an asset that should hopefully grow over time. So HomeBot can show you what your asset is doing for you. And then, of course, doing annual check-ins with you just to see what's happening with you financially and how we can provide you with resources. I want to just get a couple other final points in here. And I do see the questions coming in. So I'm definitely going to touch on those before we wrap today's session, before we get out of here. This is how you can move forward in the process. So if you're interested in meeting with me for your free consultation, there are 3 steps to begin that. One is a simple online application. We do a soft credit check, doesn't impact your score. You'll upload documents to our secured profile, or portal, I should say, and then you'll schedule through our consultation scheduler here that you can see on screen. Now, maybe you have some questions about first-time buyer programs. Maybe you want to run a credit scenario by me and just don't want to do it in class. Feel free to schedule an introductory call. That's a great way for us to get a chance to know you a little bit and just see how we can help just be a support for you in your goals towards homeownership. But that is our consultative process. Looks a little bit like this, really simple process, but it looks a lot of what we've talked about in class today. Where am I thinking about buying? What's my budget look like? Do I have some credit opportunities to help improve the cost of my financing? What are some first-time buyer programs I can tap into? Does the MCC work for me? I want to understand the workflow a little bit better. Where do I go from here? All of that stuff is going to be built into that 30-minute session for you. All right, last thing I want to touch in is we really embrace technology, whether that's mobilely, whether that's through AI and some of our tools that are available to you. Mobile can start the process for you. You can also track the progress of your loan, also follow, with calculations and stuff like that for your home purchase. But it does not replace the human touch of our business. We really try to be high touch with our business, whether that's taking inbound calls that are coming from our clients, responding quickly to text messages or emails. That's really important to us. We understand this is a big, big, big purchase for you. We want to make sure we're there every step of the way. Part of being there for you and supporting you is also providing a discount. So not only do you get to tap into resources like tonight's class, we also discount our services for you and provide you with exceptional service and product for you in your home buying journey. If you've enjoyed tonight's class too, I would encourage you to share this with your local community, friends, family, coworkers. We also have other classes that we teach throughout the year through our other partnerships that you can see on screen. We'll teach 50 or more classes just like this throughout the year. Our goal is to educate 10,000 future home buyers this year. So it's a big goal for us, but we're really passionate about serving our local communities and homeownership just like this. Here's all of my contact information. So if you have questions on tonight's class, just want to get connected with me, feel free to reach out and check out what we're kind of putting in our socials. As you heard earlier, we're going to have this video up on our YouTube so you can look back at that. I would encourage you to hear what our community says about us, whether that's on Instagram and some of the testimonies that we post, or in some of the Reddit communities that we're a part of. A lot of great comments that I get feedback on, where people find us in Reddit, because it's a big deal for us to be your resource for you in homeownership, and we don't take that responsibility lightly for sure. So thank you so much for being part of our class. I'm going to dive into questions before I sign off because I want to scroll back a little bit. I think I missed a couple, and I want to make sure that I touch on everything for tonight's class, and we'll stick around as late as we need to. I did see a question around what's the difference between Texas State Affordable and let me get to it, and the Texas down payment housing program. So they're similar programs, they have similar functions, different guidelines, different resources, but we can plug into that too as well. So we are an approved lender with both programs. So as part of your consultation process, we can see which works better. I do believe, though, TSAHC is only offering the MCC program where the other program doesn't. So that would be one of the little nuances. But yeah, we can definitely look to plug into which program is best for you, for sure. Okay, let me just scroll down. I went through that one. Okay, so does any of this change that we've discussed tonight if you buy a house for the sole purpose of renting it out? So absolutely, yes, it does. So that's called an investment property purchase. Generally, to purchase an investment property, at minimum, you have to put at least 10% down, but ideally, you should be putting 20% down. So that's if you're buying a one-unit property. And then interest rates will look a little bit different when you buy a rental property because, it is perceived higher risk. So a rental property will have a slightly higher interest rate. Now, some clients will want to, purchase a home as a rental property with a multi-unit, live in one unit, and then rent out one or two or maybe three other units that maybe it's a 4-unit property. You can do that, call that a primary residence, put as little as 5% down and then rent out the other units and use that as supplemental income. So you can absolutely do that in financing. So that's absolutely allowed. Okay. Thank you for the question. I appreciate that. Any other questions from the audience? I think a lot of people are kind of sticking around, so I just want to make sure I touch on any other things that come to mind for you guys. All right. Okay, well, I know we're 4 minutes past the hour. We had a great class tonight. Really appreciate you guys being a part of it. I have one question that came in, so stick around if you want to hear the answer to this, which is I've been thinking of targeting something like 8% when I pursue home buying. I get it's above the minimum, but it's usually competitive or no. So maybe just expand a little bit more on that 8%. I'm not sure what you mean by that, and maybe 8% return. So just let me know if you can before you jump offline. Thank you for all the kind messages in the chat. I really appreciate that. Thank you for that. 8% down payment. Okay, gotcha. So yeah, I think 8% is reasonable. So down payments as it relates to mortgage insurance and product offering, they scale at this. It goes 3%, 5%, 10%, 15%, and then 20%. So you're kind of in the between 5 and 10. So, I'd say, let's talk about your budget and see what that 8% looks like. If we can get to 10, that'll save you a little bit more in mortgage insurance, possibly a little bit in interest rate too. but I think it's a great goal. I mean, the average first-time buyer is putting 3% down, so I think 8% obviously is just going to drive that payment down lower for you. So I think it's a great goal. Awesome. All right, everyone. Have a wonderful evening. Thank you so much for being part of our class. I really hope I get a chance to connect with all of you soon. Enjoy the rest of your week. Got one more day left. Enjoy your weekend. Talk to you soon. Good night.